Welcome, ladies and gentlemen. Today we have a very interesting show. We have none other than the quarterback who quarterbacked Quantitative Easing, QE1, and his name is Professor Andrew Huszar. And Andrew, thank you so much for being on the show. How are you?
I'm great. Thanks for having me on.
You're welcome. Now, Andrew, I understand you managed for the Federal Reserve Bank of New York the $1.25 trillion agency, MBS purchase programs. Tell us a little bit about these mortgage-backed securities.
Sure. So quantitative easing, I think we got to go back a little bit and just realize where we were in the economy when it started.
Okay.
We were in the fourth quarter of 2008. Lehman Brothers had just gone belly up, and the U.S. economy was in a free fall. We had 2% GDP contraction just in those last 3 months of 2008 alone. You had 2 million Americans losing their jobs. And so basically what we had seen is that Wall Street was on fire, and it was no longer meaningfully extending credit out to the average American, and that was really having some knock-on effects to the economy. So the Fed, having done what it had done already, which was a lot of emergency programs to help Wall Street, as well as bringing interest rates as low as it could in the traditional sense, decided to do this new program called quantitative easing, which effectively was a massive program of buying bonds in the financial markets with the idea of doing two things. One was the idea of trying to stabilize Wall Street banks, taking a lot of the credit that was already on Wall Street banks' balance sheets and putting it onto the Fed's balance sheet so as to give them more capacity to lend. That was the first goal. And the second goal was hopefully, if Wall Street was stabilized, that credit would get out to the average American. So my job at the Fed was to actually run the desk that effectively was buying bonds. And there were different types of bonds the Fed was buying, but my program was the centerpiece program of QE1, so to speak, the first wave. And basically our job was to buy $1.25 trillion of mortgage bonds, basically bonds that had packaged together low mortgages of everyday Americans. And when we were basically buying those and investing in those for the Fed.
Well, Professor Huszar, let me ask you this. These mortgage-backed securities, isn't this a result of a federal program known as Everyone Can Afford a Mortgage back in 2003?
Yes, I think it goes beyond that. It really goes back to the early 80s in the U.S., when we came up with a new model where rather than make loans and hold on to them, banks increasingly began to make loans, package them into securities, and sell them to investors. So this is really a Wall Street innovation, so to speak, that the federal government then got involved on and started ensuring basically the performance of those bonds. It's really a combination, I'd say, of Wall Street innovation and the U.S. government getting in on it as well.
It sounds to me that the federal government in 2003 comes out with this incentive program, forcing all these mortgages into Fannie Mae and Freddie Mac, drove them into bankruptcy, and I think they hold like 90% of the mortgages. Now that has not worked, isn't it true that this QE1, QE2, and now this QE3 is just one big Band-Aid because of that federal government incentive program called Everyone Gets a Mortgage?
I think the federal government helped grease the skids for what happened, but I still would argue that we really started with banks. I mean, banks were the ones who were actually making loans. And this started, again, as early as the early 80s, where banks started being much more aggressive about lending and who they were lending to. And over the course of 25 years, we saw lending standards progressively deteriorate in America. And some of that was definitely a result of regulation or a lack of regulation and perhaps some incentives put in place in terms of trying to extend lending to more Americans. And some of it was the result of Wall Street just getting addicted to profits from lending and really having access to really cheap funding from interest rates being really low and getting really aggressive about lending because ultimately in their minds they weren't holding on to the risk anymore. They were actually selling it to the market, and there was a global market that had developed for these bonds. So I think we've gotten to a place just as a country where we stopped thinking seriously about the risk of lending, and that actually encompasses both Washington as well as Wall Street.
Well, now you talked about 1988 and some changes and then also lack of regulations. I'd like you to hear a sound clip of Senator Elizabeth Warren, where I think she puts it very beautifully in the way she paints the picture. I'd like you to hear it, and then I'd like to get your response. Here's Senator Elizabeth Warren on a CNBC interview, and listen very closely to how she paints this picture going back to George Washington's first term in office.
It's 1794. George Washington is in his first term, and what did we have? We had a credit crisis. In fact, if you read the local papers, it was described as a credit freeze. And every 10 to 15 years, we have boom and bust, boom and bust, boom and bust, right? We wipe out, we call them panics. The banks all shut down, have a complete financial system collapse. People lose their little farms, small businesses, until we hit the Great Depression. And we hit the Great Depression and said, you know, we can do better than that. We can write a set of rules that's going to make it work better than that. And so what did? We came up with the first one, make it safe to put your money in a bank, FDIC insurance. The second one, Glass-Steagall. Banks are going to be run like public utilities. They're going to be run boring, modest profit margins. Risk-taking will be where we can let it fail. And the third one, we get these new rules in for the SEC. Those three rules bought us 50 years of security and prosperity. And our response to that was to say, you know, regulation's just a pain. Let's get rid of it. Who needs it? It costs us too much. So we start pulling the threads out of the regulatory fabric. And we do it multiple ways. We change the laws, Glass-Steagall. We just don't appoint new regulators for whole new areas. We let the thing burgeon, and we keep the same number of tiny cops on the beat.
We let Goldman appoint the regulator.
That's right.
Would say.
So we deregulate, and we had information about this. Remember, first thing was the savings and loans crisis, right? We deregulate the S&Ls, and there's a big warning. 700 of them collapse because they don't run this right. The next one, long-term capital management. We're supposed to learn the lesson that when you sneeze in one part of the world, it's heard somewhere else. And then we hit the third one, which for me is Enron, which told us the books are dirty, right? It told us in a big public way that these institutions that are getting all these certifications from the outside, in fact, have dirty books. What were the lessons we learned from that? We just continued on our path. We collapsed the system.
Now, that is the voice of Senator Elizabeth Warren painting a picture on why the industries are acting the way it is today in this economy. What do you think of that, Professor Huszar?
I think she's on the money. I mean, I think if you look at regulation and what we've done in America with regulation and how we're thinking about it, we have slowly eroded some of the very basic and really bright line limitations of what we had around banks, and I agree with that. But I also would paint a little bit of a different picture, or at least add to the picture that she's painting, which is to say, let's look at what's happening in the U.S. economy overall. So Wall Street, as a percentage of the U.S. economy, has doubled from the mid-'80s to right before the financial crisis. So basically, Wall Street was accounted for 20% of corporate profits in America in the mid-1980s. And by the financial crisis, it was at 40% of corporate profits. And you also had this huge concentration of banks where we allowed our banks to get much bigger. So in the mid-1980s, what 87 banks controlled in terms of the asset size, by 20 years later, 6 banks controlled. So we had this huge explosion in the banking sector and huge explosion in concentration of bank size. And what was that really doing? Well, it was compensating for the fact that in the underlying economy, we stopped making a lot of the investments in our economy that we need to, whether that's in infrastructure, education, whether we thought strategically about our taxes or our regulation. We started trying to use credit to compensate for the fact that the median, the income of the average American has been on a 35-year decline. And the answer became, let's let more Americans have more access to credit. And so the average American from the mid-1980s to the financial crisis, as Wall Street was exploding in size and concentration, the average American became 3 times more indebted during that period of time.
And I got to ask you this. I got to stop you there and ask you this.
Yeah.
You said that from 1988 to 2000, prior to the 01 and 02 crash, that the markets had doubled and corporations have gotten their profits. Is Wall Street about growing the corporations and using the everyday investor as kind of like kindling wood to start the log called corporations to grow the economy? What does Wall Street think of the everyday investor? And is it just about the corporate profits? When is it going to be about the investor that has been the backbone of the financial economy in this country?
Yeah, I mean, I think that's a great question, and I think, it's hard to paint all of Wall Street with one brush because there are obviously different types of corporations and some that are better about worrying about investors than others. But, I mean, if you look at the big banks, it's clear that their business model does not revolve around the everyday American at this point. And I was a managing director at Morgan Stanley, a big Wall Street firm, and I thought we had gotten to a point, and this kind of comes back to QE, I thought we got to a point with the financial crisis where we kind of saw that we let these banks get too big and too self-centered, and we were going to make some moves to actually hopefully tweak the model and just get them a little bit smaller and focused again on us, the everyday American. And instead, all of what's been happening, or at least a lot of what's been happening, has been basically doubling down on Wall Street in the last 5 years. And that's one of the reasons I ultimately wrote my op-ed, is because I feel as if we had this pretty substantial opportunity to see change in the economy 5 years ago, and yet we're only going down the same path, and all the public policies that we're seeing are just trying to recreate the very economy that we saw blow up 5 years ago.
The Fed has positioned quantitative easing as a policy designed to help the everyday investor. Right. Do you think quantitative easing has achieved that mission?
Let me just say, I believe in the Fed, and I think the Fed's going to be 100 years old on the 23rd of December, right? It actually didn't exist for a long time.
What's going to be the celebration? Increased taxes?
There's a reason the Fed exists, and I worked there for 9 years, and I believe in the institution, and I believe the people inside of it are smart, well-intentioned. But I think what's happened is the Fed has progressively lost perspective, and as Wall Street grew in size, the Fed became more and more beholden to the idea of Wall Street being a huge part of the economy. And so a lot of what we've seen post-financial crisis has been this idea of trying to get Wall Street healthy again and hoping that would help the average American. And the reality is the Fed can only operate through the banks. The Fed basically does all of its financial operations through banks. And my real issue is that all of what we've done to put Humpty Dumpty back together again in terms of the banking sector, it really isn't trickling down to the average American. We haven't seen really a meaningful increase in lending since the financial crisis. We've seen the Fed pumping money into $1 trillion a year into Wall Street banks with the idea that this would help. And all we're seeing is the stock market go up in value, which is great. There's a real question as to how much it's sustainable, and 10% of Americans own 90% of the stock market, and so there's real questions as to how it's really helping the average American.
Isn't the Fed basically made up of Wall Street professionals and executives?
Not.
I mean, Goldman Sachs comes to mind.
Years, yes.
When I see financial firms like Goldman Sachs fleece their investors to the tune of $1 billion, the regulators come in and fine them $500 million, and it doesn't go back to the investors. Does that not seem like a racket to you? People being fleeced, regulators coming in?
Yeah, I mean, I think if you look at the Fed specifically...
Well, we're not specifically pointing out any one person at the federal government agencies, but we're pointing out the end result of what the federal government is not achieving.
No, I agree. I mean, I think what has happened within our government is we've come to think of Wall Street as, I think, excessively as the engine of our economy, rather than as what Elizabeth Warren was talking about, which is this idea of banks helping to facilitate growth in our economy. And what we've done is we've allowed, to your point, we've kept the profits to Wall Street, but when they start generating losses or they do something illegal and are fined, suddenly we're socializing the losses. We're suffering the downside, and we're, as an American public, and we're seeing very little of the upside.
Ladies and gentlemen, you are listening to none other than Professor Huszar, who is part of the reason quantitative easing has taken place. He has quarterbacked it. And Professor Huszar believes that the Fed is increasingly tied to Wall Street as all of its efforts are now centered to Wall Street and harm the everyday person. Is that something you believe?
I do. But I believe there's a larger issue, which is that I think the Fed feels as if it's the only game in town in trying to help what's a very poor economic picture in America. And so Congress is gridlocked. We're not getting a lot of creative policy making from the executive in terms of real structural reforms in the U.S. And so the Fed feels like it's the only game in town. And because the Fed basically can only operate through Wall Street, its policies are inevitably going to benefit Wall Street disproportionately. And so we are seeing what is effectively a doubling down, an ongoing bailout of the banks with the hope that's going to help the average American. But my contention is the Fed doesn't really have the tools to help. And in some ways, it's creating far more complacency about the average American and the fact that the average income in America is back to what it was in 1995.
Wow.
We're going backwards.
Yep. And others say about Professor Huszar that he will not openly speak against the federal government. In fact, he stands by the statement that he respects the Fed, and you've done that in this interview, and thinks they mean well, and you've done that in this interview. He only speaking against the negative results of quantitative easing. Is that true?
That is true. I believe in government. I believe in smart government, and I think what the Fed's doing and what we're seeing in the rest of the government, it's just not smart government. And if you think of the U.S. economy as a business, we're not dealing with our issues. We're just kicking the can down the road, and this is probably not going to end well in a number of different ways.
Do you think the fundamental of the economy can support the heights of the market?
Fundamentally, I don't, because I think what you have in the U.S. is you have a U.S. economy that's 70% dependent on consumer spending, and yet the average U.S. consumer is hurting. And so unless we actually do some work to improve the underlying economy, this stock market is increasingly going to look bubble-like. And as long as the Fed keeps on pumping money into Wall Street and some of that money gets into the stock market, it will keep that market going. But more and more, that market looks as if it's being driven more by the Fed pumping money into Wall Street rather than the underlying performance of our economy. And that can't go on forever.
Can you honestly tell me the $85 billion that the federal government is pumping into these bond purchasing programs, is it truly going to help the economy grow, or is it setting it up for the next big bubble to pop?
Yeah, I think, to me, the benefits are pretty minimal. And to me, the costs are, one, that we are pumping up Wall Street and letting them get back to where they were, which I think was too big and too powerful in our economy. And two is that we basically are setting up the financial markets for a fall when the Fed stops buying. And I do think that's where your listeners, being people who worry about their investments and want to be sure that they have a secure future, they have to be really careful, because what the Fed basically has done is that it has basically killed the return on bonds. And so it's pushing more and more retirees, for example, into stocks. There's a short-term benefit of that, but stocks, as we've seen, are very volatile. So I think people have to be careful about how much they commit their savings to a policy that is looking more and more artificial and has some real danger to it.
Is the federal government getting their cake and eating it too? And what I mean by that is, are they increasing our taxes and doing all this quantitative easing and doing all these bailouts and $1 trillion to the banks and everyone gets a mortgage and roll your clunker in for $4,500 to any dealership in this country? Does it seem like they're getting to spend the taxpayers' money and then raising our taxes and then not regulating and people getting fleeced on the markets? Does that sound logical to you?
Having been in that seat and having, overseen $25 billion of bond purchases a month at one point in my career, I again have a lot of confidence in people in government, or at least believe that they're well-intentioned for the most part. But what's happening is we are getting very short-term oriented in our thinking in America, and in this constant media cycle where we're thinking about, from day to day what's happening, there's a real temptation to try to do a lot of short-term things that help juice the conditions and make things look better in the short term, but are long-term very ill-advised and inefficient. And I think that's what's happening. I think the government is ultimately trying to, rather than make some really difficult moves in terms of actually arguing possibly for more government spending, but smarter government spending and cutting other programs that just aren't working, we're just doubling down on policies that aren't working, and with the hope that it's just going to get us through the next 6 months or the next year. And the reality is, I think 5 years ago with this financial crisis, we actually had a moment where we should have said to ourselves, the last 25 so years or so in our economy, there was a lot of benefits to it, but there were a lot of costs. This financial crisis ended up being very painful.
Wouldn't it have been better if we were going to take $85 billion of artificial money being printed without gold? Wouldn't it have been better rather than the pumping into Wall Street, the pumping into an infrastructure, putting people to work, repairing our bridges in this country, expanding our highways, traffic jams everywhere? Wouldn't it have been better for the federal government to put many workers and get back to the fundamentals like we did in the 50s, like we did in the 60s with infrastructure? Would not have been a better way to spend this $85 billion? Who made the decision on pumping up Wall Street instead of the country and the everyday people that made it?
Well, I think, to be fair to the Fed doesn't have the ability to go out and make those investments. I am 100% on the same page with you. That's what we need to be doing. The reality is the Fed looks at the rest of Washington, throws up its hands and says, these guys really can't get anything done. So even though our tools aren't ideal, let's try to do something to try to help the average American. Reality is, I believe that all it's doing is feeding complacency about what needs to be done. And if you look at the Senate, There's a bill in the Senate called Brown-Vitter that has some really credible reforms about Wall Street banks that has bipartisan support and is just sitting there languishing. And if you look at the House, there's a bill that talks about infrastructure development in the United States and has some really interesting ideas about infrastructure development, which again has bipartisan support, at least from members of both parties, and it as well as languishing. So I think we're getting into this very defeatist part of time where we say to ourselves, you know what, we just can't get anything done in Washington, so let's just try to do a less good thing. And the reality is, I think that's defeatist, and in the end, it's leading us down the wrong path.
How is it that people who represent the everyday little guy, congressmen, presidents, senators, how is it they can tell people what kind of health insurance they have to have and they don't have to have the same? How's that representing the everyday guy?
Well, I think you can look at across a number of policies in the government and say to yourself, do both these political parties have an idea of what they're really doing, or are they just talking to the wrong people? Are they having the wrong ideas? I'm just very frustrated, and the reason ultimately I spoke up is because I wanted to try to explain what's been happening, put it into some context, and really, it's really hard. It's really hard at a time when the stock market is at an all-time high, and where the financial markets are humming overall. It's hard to say, you know what, we still need to do some difficult things. But the reality is, I think we're going to get back to that place where unfortunately we have some more pain, and we're going to say to ourselves, wow, I wish we had done more ahead of time. And so ultimately that's why I was motivated to write this, and that's why I'm speaking up, is because I really want to help provide my background and my experiences to try to help people get a better sense of what's happening and some of the ill-advised decisions we're making.
Well, Professor Huszar, we need more thinkers exactly like that. And that's what the Crash Proof Retirement Show is all about, is educating people on how to get a more secure retirement. Joanne Small and myself, we sit around often and talk about the everyday investor. And why is it that the everyday investor takes the risk of Wall Street, but Wall Street never takes a risk on the everyday investor? Does that seem like a fair game?
I mean, it's a really good point. So in my program, for example, just to take it back to where I was from 2009 to 2010, so the Fed comes up with this new policy of investing, of pumping effectively, in my program, $1.25 trillion into Wall Street with the idea that it's actually going to stabilize the banks and stimulate lending, mortgage lending. From day one of our trading, which was in January of 2009, to the last day, which is the end of the first quarter, or the end of March 2010, at the same time as we were pumping all this cash into Wall Street, we actually saw a net decrease in the amount of mortgage lending in America. And so clearly the tool wasn't working in the way the Fed suggested in terms of easing credit for Americans, and yet we've seen $2.5 trillion more of.
Why continue if we knew it's not going to work?
I don't know. I mean, I think that's the real question. And if you look at the politics of it and you look at sort of the state of Washington, you can understand where people are coming from and why they want to try to help no matter what. But it's clearly not working. And I think those people who are concerned as citizens, we need to really talk with each other and try to come up with better solutions for how to get America, the U.S. economy, working for all Americans.
Why didn't the banks lend money? They were given $1 trillion. Why did the government depend on it being trickled down? That's like us giving a thief the keys of our car and say, valet, park it for me. Why wouldn't they lend the money out, these banks?
Well, I think ultimately because they got so much, and this is my opinion, but I think they got bailed out in so many different ways that ultimately they weren't really forced to confront the implications of what happened.
It's kind of like a form of atrophy, right?
Yeah, well, it's business as usual, right? I mean, if you mess up and suddenly you don't deal with the consequences of your mess, why would you change how you're doing things? And so banks kept on doing what they were doing, which was they were really worrying about themselves. And so a lot of the cash that they got from the Fed, they turned right around and they actually did what a lot of us did, which is that they started investing in the markets because they figured, if the Fed's pumping this much money into the economy, into Wall Street, it's going to help the financial markets. So that's exactly what the banks did. And, the big Wall Street banks in particular, the 6 biggest ones, which are such a huge part of our economy, their business models still aren't entirely oriented around lending.
Aren't some of these big banks also part of the federal government?
We have big corporations in America, and those big corporations have lobbying dollars and have a lot of credibility because they are such an important part of the economy.
Can we talk about the real organization that runs this country that I would call lobbyist? Isn't that what Congress responds to?
I think it's a huge problem, right? The influence of money in our politics. I didn't work in a part of the government in which we dealt with lobbyists. The Fed has remained somewhat independent from that world of Congress, but I would agree with you.
I have one's a world famous economist. His name is Dr. Mark Faber. Have you heard of Dr. Faber? He's the publisher and editor of the Gloom, Boom, and Doom Report.
I have not, but I look forward to checking it out.
Okay, I'm going to let you hear what he has to say about quantitative easing and being disconnected as an investor, and I'd like to get your response to his comments.
Sure.
Here's Dr. Mark Faber.
In the 40 years I've been working on Wall Street, we never had a disconnect as we have today between the lives of ordinary people, the middle class and the working class, and Wall Street. Wall Street is in the sky, and for the typical American, the average household in America, their incomes are down, and in my view, what the money printing has done, and we have precise statistics about this, it has widened the income and wealth disparity in the United States, or the wealth inequality. The rich have become much, much richer, and the typical household has become poorer. These are statistical facts.
That's Dr. Faber. Do you agree with that, Professor Huszar?
I agree. I mean, if you look at, and this is a longer-term trend, right? This isn't even the last 5 years. This is now 30 years. But if you look at 1983 to today, the average middle-class American has had basically a 6% increase in their net wealth, which sounds almost okay until I tell you that the wealthiest American has had an 87% increase in their net wealth. And so we have so many different ways of structurally unsound U.S. economy, but one of them is that we have the average American and the middle class of America falling behind further and further. And I think from a long-term perspective, that's a really negative factor across a number of different levels for the U.S.
Do you think brokers, Main Street media, and people like Jim Cramer are good for the market or bad? And how they report on what's going on?
Well, it's really interesting, and I think that's a fantastic question. So I'd say a couple different things. One is, if you watch CNBC or a lot of these shows, and not all of them, but a lot of them, they're really bullish for what's going to happen next year. And if you talk to most Main Street Americans in the polling that you see, most Americans are very negative about what's going to happen. And I think that's the reality. We have this increasing idea in America that the financial markets are the economy, and they really aren't. They're a part of the economy. They're an important part of the economy, but they're just a part of the economy. And so I wrote this op-ed, and I found myself in a lot of these shows, and I really appreciate being on this show. I really enjoy what we're talking about. But, I met with almost 100% skepticism about, why are you apologizing? Why 5 years? You helped, you're a hero. I mean, it was very complimentary. I appreciated it. But the reality is, there was such relentless skepticism about what I was saying. Mm-hmm. And all I'm trying to say is, let's keep our eye on the ball here in this country, and let's really figure out how this hasn't helped the average American and how we can get the average American better off. And I think we're losing sight of this with a lot of this mainstream media dialogue because their eyes are not on the ball. But one thing I've loved about what's happened is that we do live in the greatest country in the world. I wrote this piece, which was very critical about the government and about what we're doing, and I've been able to go on a lot and speak about it. In fact, a lot of these shows had me on. And so I do want to celebrate in America this idea of free speech. I think it's pretty incredible that we have it. I do appreciate that I get to go on a lot of these shows and that these shows exist. I think that's really important. I think the problem is we have so much information that it's overwhelming. And the prospect for confusion and misinformation is too high. And so I don't know how we get around that, and people do have their own agendas, and that's a problem. But I do believe, I do hope I go back on these shows because when they have me on, I get to say talk about my views, and even if they push back, we need to have this debate. We need to talk about these issues. Otherwise, we're just going to end up doing this anyways.
What can you tell our listeners? Our retirees and people coming up to retirement who want to retire, what can they do to protect themselves against the volatility of the markets and eventually the ending of quantitative easing? What can you tell them how they can secure their accounts?
Well, I think it's a really hard time for a retiree. My heart goes out to your listeners. But if I was going to give some advice, and obviously the first thing I'd say is try to get as much advice from as many people as you can that you trust and really come up with a plan and stick to that plan. And I'd also say, it's not bad to be in the stock market. I mean, let's be real. The Fed and the U.S. government right now is pumping up the stock market. And so there's a certain amount of profits that you can get there, but really be careful, like you always would have been about being in the stock market, and really be comfortable that you might lose, because the reality is stocks don't only go up. Sometimes they go down pretty dramatically. And so I wouldn't jump into stocks right now because the stock market's an all-time high. Often we see that those are the times where people get hurt the most. I may be more open to the idea of being in stocks, but just keep it to a relatively manageable part of your portfolio and be very vigilant. Keep on watching what's happening with the Fed and with government, and make sure that you're staying on top of your investments.
One of the oldest financial rules, the first cardinal investment rule, is you get in low and you get out high.
Right.
Now, we know quantitative easing has been going on for quite a while, and it has many economists believing that it has pumped up this bubble called market highs. Do you believe in the near future, since we've been up for 5 years, that there's an economy crisis coming, or at least a correction?
Well, I think, and again, this is purely speculation, so, take it for what it is. I think the Fed's going to keep on buying because, as we were saying before, the more you buy, the more the risk is when you stop buying, the market's going to go down, and that's a really bad result for the Fed. So, I think we have an addiction problem right now, and unfortunately we had a bad moment 5 years ago, and we basically doubled down on the addictions. I think that correction's coming. I tend to think it's probably a longer-term thing, and one of the reasons is because the government's going to keep on doing what it's doing, and I think that's a bad thing, but I think that's just the reality.
So the consequences of the federal government delaying and continuing the quantitative easing, you feel that this bubble that's there now will continue to blow up until it pops?
I do. I think the Fed has proven that it's all in, and as long as it keeps on thinking it's the only game in town, that almost becomes a self-fulfilling prophecy, and people start looking more and more to the Fed to keep on doing what it's doing. So I do think if the Fed suddenly talks meaningfully about pulling back, I think your listeners should be very aggressive about repositioning their portfolios away from stocks. But I think the Fed often talks about it. We'd have to start seeing some meaningful action, and I think talking and acting have proven during the last 5 years to be two very different things.
Have you heard of an economic forecaster by the name of Harry Dent?
I've heard the name, yes.
Harry Dent is a best-selling author of 2 books on the economy. He has accurately predicted the late 90 boom in the early 90s, and he also accurately predicted the 2008 crash. I had the opportunity, as I have with you, to interview Harry Dent about 3 months ago, and I asked him how he figured out his predictions, and he talked about scientific demographics. And then I had to ask him, what is your prediction in the future? And I'd like you to hear this 60-second clip on what he says and get your opinion on it. Sure. Here's Harry Dent, best-selling author of 2 books on the economy.
I'm predicting the Dow's going to go up to about 16,000 to 16,700 by early next year, and then crash to 5,800 by 2015 or 16. Higher highs, lower lows, because these bubbles, especially this last one, is all on stimulus. $2 trillion a year on average between quantitative easing, monetary injections, and fiscal deficits. $2 trillion a year to create $350 billion in GDP at 2% growth. This is a horrible ratio. But if you just preserve what you have in this bubble, you're way ahead just on that.
Economist, forecaster Harry Dent, the author of 2 best-selling books, giving you his prediction for 2014 and 15. What do you say, Professor Huszar?
So I agree with him that this is a terrible trade, and I actually believe that we need some investment in the economy by the government as well as by the private sector, but I think it needs to be much smarter. But again, he's clearly has some history behind him to show that he has some credibility. But where I come out is that I believe that we're going to keep on seeing the U.S. government, and particularly the Fed, continue this stimulus. So as long as the stimulus keeps going, I don't see short-term potential for a huge fall. I could see the stock market, when we finish QE1, to give you a sense, in the next 4 months, we saw the U.S. stock market fall 14%. So if the Fed starts meaningfully pulling back from stimulus, I think the potential for stock market fall is significant. I just think the Fed's going to do this far more slowly than people think, and I think we're probably talking about the Fed continuing to buy bonds indefinitely on some level because of this prospect of the markets actually crashing or at least falling dramatically. So that's where I think as long as we keep the pump going, I don't see that happening.
You know, that makes me think of something, Professor Huszar. Isn't this a vicious cycle where the federal government is spending the United States citizens' tax dollars and making them dependent on Wall Street?
I would go back to the story that I painted before in terms of from the 80s onwards, Wall Street becoming a much bigger part of the economy. And then when the crash happened in 2008, the U.S. government, particularly the Fed, stepping in and taking on a lot of the role of Wall Street. And so now we keep on doubling down on this policy. Not, when Wall Street wasn't working really the way we wanted after 2008, the Fed stepped in with these bond purchases. And so what I'd say is we keep on trying to paper over a growth issue and a structural problem issue. And the more unorthodox things we do, the more we ultimately make the situation worse and kick the can down the road.
Now, all these incentive programs that they did come out with the 80s, these retirement plans, these 457s, 403Bs, 401Ks, these were all government stimulus type retirement plans that were put in place, but it forces people on the market because you don't have a safe choice in any of those type programs. It's all about securities. So when I think of Wall Street, particularly in the last 15 years, the first thing that pops in my mind is federal government. It used to be the economy. You'd say Wall Street, you think of economics, you think of the economy, you think of investments. You say Wall Street today, I think of the federal government not regulating and people getting fleeced. When I think of the federal government, I used to think of our armed forces and our infrastructure and how our federal government was there for the everyday United States citizen. Now when I think of the federal government, I think of Wall Street. What do you think of when you think of investor? Everyday investor, what's the first thing that pops into your mind?
Maybe I'm an optimistic person. Maybe that I worked in the government for as long as I do. I maintain a huge amount of confidence in our government. I think our government needs to get its eye on the ball, as I said before. And I do think, to your point, that right now the government's perspective is on, let's try to make things a little bit better for tomorrow. And I think what we really need to do is have a serious conversation about where do we want to be in 30 years as an economy and how do we get there. And until we have that conversation, you are going to have Wall Street having too much influence in the conversation. You are going to have short-term, ill-advised policies by our government officials, and we just need to be more strategic about this, and we need to stop being as tactical. And that may actually mean things may get a little bit worse in the short term, but that may be okay if ultimately we're headed in the right direction as a country.
Now, Professor Huszar, I have a soundbite I'd like you to hear. This is then the Inspector General, H. David Kotz, arrived at the Security Exchange Commission in 2007. Prior to coming to the Security Exchange Commission as the Inspector General, he was the Inspector General at the Peace Corps. He remained there until January 31st of 2012, so he was there for 5 years. I had the opportunity of getting an interview with the Inspector General in 2011. I'd like you to hear the question I asked him, because I feel that unless there's more regulation from the federal government, now we have enough regulation in place, but they don't enforce what's in place. Right. And I asked that very question of Inspector General Kotz. I'd like you to hear what he has to say. Walk me through your thoughts in your mind and tell us what you think is your biggest block in trying to accomplish what you're trying to do here at the SEC. What's your biggest challenge?
I think just generally in the federal government, management is often a big challenge. Taking appropriate action where there is wrongdoing or misconduct, and managers often are reluctant to take action against people who work for them. It's difficult to take action. It involves litigation, can be very messy. It takes time out of the regular work that you do. I think in general, that's always a challenge, to get the manager to do the right thing, whether it's terminate or discipline an employee who engages in wrongdoing. It's very important to do that because it sends a message to the rest of the folks in the agency that this is not going to be tolerated, and then you have a much more productive work environment.
That's the voice of Inspector General Kotz, then the inspector from 2007 to 2012. And there in that soundbite, he's explaining how his own federal government agency does not want to take appropriate action on their own inside that agency who are committing inappropriate activity. As long as we have government regulations on the books, but regulators that don't want to regulate, do you think that's a problem with Wall Street being in the government, such as the Security Exchange Commission and Goldman Sachs?
Yeah, I mean, I'll be honest with you, and again, maybe this will shock you coming from someone who worked at the Fed, and before I was working on the trading floor of the Fed, I was a regulator of banks as well.
Mm-hmm.
I don't believe that we can have a huge amount of confidence in our regulators per se to push back on banks. In the U.S., we have 5 bank regulatory agencies that are responsible for banks. So even if someone in one of them has the right intention, there's 5 of them that have to agree basically on most anything that happens. And it's just not going to happen realistically, especially with these huge banks the way they are. I think really what we need is really easy, bright line rules. We don't need 10,000-page Dodd-Frank bank reforms.
Mm-hmm.
We need 20-page reforms where we say, this is what we had, the Glass-Steagall Act, where we said,
and it worked.
An investment bank does, this is what a commercial bank does. We're not going to try to get involved in every little thing you do. We're just going to say that here's some really bright rules that you have to follow. And if we had those simpler regulations, and we weren't hoping that someone in government would step forward and regulate every little thing, I think it would create a lot more confidence and it would be a lot more effective.
Isn't it funny that people who are outside the government these days know what the government should do, but ones who are in the government have no clue?
Well, it's really hard when you're in the government and you are dealing with this labyrinthian institution to make change from the inside. It's going to be incremental. And the reality is, what I'm trying to say and what I've been saying is we actually need some more meaningful, serious reform. And that does involve regulation, but there's a smarter way to do government.
And I like the way you said it. You keep it simple, but enforce the laws. And that, I think, will sum that up. I have one last soundbite that I'd like you to listen to, and this is the Inspector General Kotz. I asked him, after him giving us that answer, that regulators are not regulating on themselves, that managers don't want to take action against their own inside these federal government agencies that are doing the wrong, inappropriate activity. So I asked the Inspector General, what do you have to say to the everyday investor who's trying to reaccumulate, should they even be on the market? I don't think you're ever going to hear another high-regulated official like H. David Kotz say what he's about to say to you now. Here's H. David Kotz, then the Inspector General of the United States Security Exchange Commission.
Do you think it's prudent for people to have their nest egg in financial instruments that are risky, that can no longer go back out and reaccumulate a nest egg?
Well, I mean, I wouldn't presume to tell anyone sort of how to invest their money, and I'm not an investment advisor. I think we do have a situation today where so much money is in the stock market, where people's lives are so affected by it that sometimes it may make sense to take things out in turbulent times to ensure that you're not living and dying, so to speak, by, the Dow Jones going up and down, particularly with what's occurred over the last several years.
That's the voice of H. David Kotz, then the Inspector General from 2007 through 2012, January 31st. What do you think about that, Professor Huszar?
I think the reality is, let's look at our stock market. 10% of Americans own 90% of stocks in America. So the reality is, I definitely think we need to be prudent about financial assets and financial asset management. And I think it's really important that your listeners find someone who can help them manage their assets in a conservative but effective way. But I think ultimately we're talking about a growth story, and we need to get to the point where people are generating earnings so that they can actually retire. That's partially the financial markets, but it's also about investing in the underlying conditions for growth in the U.S. and making sure that we have the playbook right for going forward. And I just think we need an effective financial market for the U.S. to work, but we also need an effective educational system, effective infrastructure, all the things I talked about before. And so I'm worried that this economy just isn't working for most every American at this point, or at least too many of them.
Back in 1929, during the Great Depression and through the 30s, the insurance industry was the only financial industry during those time periods that had no problems, financially speaking. And again, in the 72 recession, no problem for the insurance industry, financially speaking. There are a lot of financial vehicles that are insurance-based but do outperform the market. And then again in '01 and '02, the insurance companies were not even braised by a 72% drop in our markets. Why do you suppose that is?
Well, I think it's the nature of insurance companies they tend to hold longer-term assets. Unfortunately, we did see, to be fair, in 2008, some insurance companies did have problems, and some of them got TARP money from Congress. So, I think the reality is we need to be vigilant about all these companies at this point, especially the large ones. I like to say that in the U.S., 0.2% of banks control 70% of the banking industry's assets. So what we've had is these huge growth of these companies, and like any big company, there's a lot of complexity there. And so it really, the simpler products for your customers, the better.
Here's the thing, Dr. Huszar. I agree with what you said. The insurance companies, some of them did receive some of that TARP money, but the ones that did, I'd like to explain and see if you agree or disagree. The ones that did was AIG. Their bank went into bankruptcy, but AIG, the insurance company, did not. Their bank division did. AIG, the life insurance company, has $1 trillion in their legal reserve account. The insurance companies that had to take the TARP money were those that sold these ill-fated investments known as variable annuities. That is what put insurance companies into that bucket with the TARP, because they were invested in the stock market. Now, it's 5 years later, and many of these variable annuity insurance companies are now scaling back on some of the. Yeah, they're kicking. Yeah. They're getting much more conservative because they realized for the first time in the 300-year history of that life insurance industry, and some insurance companies did get hurt in '08. They didn't go out of business, but they did get hurt. Many people don't realize insurance companies cannot and will not file bankruptcy. It's something called receivership, which brings me to my next question. Are you aware of crash-proof investment accounts that came out in 1995? Wharton School of Business did a 2-year in-depth study on these vehicles. And after a 2-year in-depth study with 6 PhD economists from Wharton School of Business, that study concluded that these crash-proof investments that came out in 1995 since their inception has outperformed government and corporate bonds, money market accounts, equity mutual funds in any combination in not just 1 year. They've outperformed the markets every single year, and that was without the risk of loss of principal, without the ongoing fees. Are you aware of the vehicles I'm referring to?
No, I'm not aware.
Would you be opposed that we get you some information on that?
Sure.
Great. You touched my heart when you said, I just want to get it out there. I know I'm the one that quarterbacked QE3, but now I want to get it out there, and I want to apologize because it's not what I have intended. That's kind of what you said. And I think that's a stand-up guy, and I think that the way I say it is when I hit the 2-minute warning of my life, and I'm on my bed looking at my ceiling and in my life, how do I want to look back? Am I going to say if I knew then what I know now, would I've changed things? And I think that that's what you're realizing at 41. You have a prestigious background. You sound like a guy that really does care, and I don't meet many people like that, and I don't talk to them the way I'm talking to you right now. I'm just giving you my heart and soul, and I truly respect that. I don't want you to ever stop doing that. I don't, man. We need more people like you. We need you to step forward.
I'll be honest with you. I was an MD on Wall Street. I sort of was living that life, and I just thought to myself, you know what, you're here on this planet once. And if you really believe in something, and clearly I worked in the government for 9 years because I do believe in the government. I believe we got to get this thing right for where we're going. I just thought to myself, I should speak up and say something. And it took me, to be honest, a few years to get there because I do have a huge amount of respect for that institution and for the people in it. And I recognize it brings a lot of negative attention to them in a way that I hope it wouldn't. But in some ways, I think we have to talk about certain things. In other ways, it's obviously going to fuel some more criticism that may not be as fair. But at some point, if we can't have the conversation, where are we going to go?
Tell me in your life, what is your biggest achievement and what do you want your future achievement to be?
Wow, that's a big question. So my parents immigrated here from Hungary. They escaped communist Hungary in the 60s and came here. And so there is no bigger fan of this country than me in terms of someone who really appreciates what this country gave to my family and to me, the opportunities. And so you're going to be surprised if I tell you this, but I think my biggest achievement was working at the Fed and helping to work on behalf of the U.S. people. And I did some things that I will be forever proud of in my life there and worked with such incredible people. I think at a certain point, I think some of what I did with the best of intentions, I think helped cause some of the issues we talked about, or at least helped contribute to them. So there will be also some regrets I have about being at the Fed. But my time at the Fed has been the highest and the lowest. And I guess going forward, what I'm trying to figure out, having had this path laid out for me in terms of, I could have worked on Wall Street the rest of my life and had those financial rewards, but it didn't mean as much to me as the idea of trying to find a way to contribute, I think, more meaningfully to society. And so that's what I'm in the process of doing. This has been part of that in terms of figuring out how I can make the most positive impact, and whether that's maybe going to business in a different way and hopefully having a socially positive impact on it, because I ultimately believe in entrepreneurialism, or whether that's just talking more about the issues. I'm still trying to figure that out.
If you had to say something to our everyday investor who's listening in right now, what would you say to them in the coming years to secure what they've worked for all their life? Like your mother and father, who probably struggled to get you to this country, and their mom and dad struggled to get them where they're at. What would you say to the first generations in this country, the second generations, the 16th generations, right, who have their future on the stock market? What would be your advice?
Well, I think you need to be careful, as kind of I talked about before, in terms of how you manage it. But I think more fundamentally, I think as Americans, we actually need to be positive at this point, and we need to figure out how we can impact the future rather than throwing up our hands and saying, it's screwed up and that's it. And the reality is, it's hard because, one, who are any of us really to make a difference individually? And then two, you do have financial markets that are doing fantastically well, and you have certain people that, as you've talked about, are loving that situation. But I think this is the greatest country in the world, and I think it's just a matter of fighting for the future and making sure it works for all Americans.
Andrew, what an incredible interview. I want to thank you, and I want to tell you that we have an open door policy for you, sir, to come on the show.
Thank you so much. I really appreciate it, and I'll probably take you up on that at some point, but I really enjoyed the conversation.
The Crash Proof Retirement Show has been a production of RMI, Retirement Media Inc., Truth for the American Retiree.